Welcome to the Randy Selzer Real Estate Podcast, where we discuss important topics for buyers, sellers, and investors in the Toronto area real estate market. Here's your host, Randy Selzer.
Hello, everybody. It's Randy Selzer here. Welcome back to my YouTube channel, or if you're listening today on the podcast. Today, we have a very special guest. Robinson Smith is here, and he is an expert in mortgage matters and also in tax planning. And he's got a family legacy happening here. He's also got a best-selling book today on Amazon. I just found out that it's #1 on the bestseller list. So welcome, Rob. Nice to have you on board today.
Oh, it's a pleasure. Thanks for having me on, Randy.
No problem. So today we're going to delve kind of deeply into stuff that a lot of people may not know about. Most people, when they get a mortgage on their house, they don't give it much thought. They talk to their bank or their lender or perhaps to a mortgage broker, and it's a loan on their house, and they just pay it off. It's there, and it's one of those things they have to renew the terms every 5 years or whatever. And I think most Canadians are aware that the interest on mortgages on your principal residence here in Canada is not tax deductible. In the United States, it is. I think a lot of people might know that. Oh yeah, in the United States, they get to deduct their mortgage interest, whereas we do not. But your company, starting with your dad and actually carrying on with you, have found a way a way that we can make that tax deductible. And it's called the Smith Manoeuvre. So I'm going to turn it over to you, sir.
Yeah, well, thanks, Randy. Basically, my father, Fraser Smith, back in the mid-'80s, he became a financial planner. And he was interested in the fact that, as you say, the Americans could deduct a good portion of their mortgage interest, whereas we Canadians could not.
Why does that not surprise me? Okay, go ahead. Sorry.
and Fraser didn't think that was very fair at all. So He did what anyone would do, which is read the Tax Act, right? It's fantastic bedtime reading. And so
Okay.
from all that, he came up with what he subsequently called the Smith Manoeuvre. And it is, as you say, a way to convert your non-deductible mortgage interest to tax-deductible interest on a Canadian principal residence mortgage. So he put his private clients into it for about 15 years before he retired in 2000. And he came out with his book on the subject in 2002. So since the mid-'80s, there are thousands and thousands of Canadians who have been implementing the Smith Manoeuvre. And an increasing awareness now that I've come out recently in 2019. And in 2019, I published my book, Master Your Mortgage for Financial Freedom. And as you just mentioned, #1 today. I'm glad to hear that. I didn't check, but came out at #1 in 22 categories on Amazon on launch day.
Not bad, man. Not bad.
Well, that might not be the only time you hear me brag, Randy. But so sales are still going very strong. And, my dad passed away in 2011. He came back into advising. He came back into advising in 2005, and I joined him in 2006. He passed away in 2011, and I kept on going as an advisor until the middle of 2018. And I sold my advisory at that point because I wanted to sort of continue my father's mission, which was to make sure every Canadian homeowner coast to coast was aware of this strategy. Okay. And since he came back into advising in 2005, he didn't really do any promotion of the strategy. He was busy with his own client base, and as was I when I joined him in 2006. And so getting back out there to the Canadian homeowners is really my primary mission right now with the release of my book. I'm doing a lot of speaking engagements, people such as yourself, personal finance groups, real estate investment groups, etc. So word's getting out, and Canadians are becoming aware of this, which is fantastic because it's not easy out there, as you know.
One thing I can tell you, I know from my experiences as a born and raised Canadian, we pay too much tax on everything. Man, I don't know. It's just and it's a lot of hidden tax that you don't even realize that you're paying. But every time you fill up your car with gas, every time you pay your insurance, all that stuff, there's hidden taxes in that. And of course, when we're talking about real estate, we're talking about large numbers, large payments. So tell me more. It sounds good.
Yeah, that's absolutely right. We Canadians pay more in tax than we do on food, clothing, and shelter combined. And if you know Maslow's hierarchy of needs, the basic, simple requirements for existence, right? We pay more in taxes than we do in all of those combined. So yes, we're consistently within or close to the top 5 highest tax-paying citizenry on the planet.
I believe it.
Now, I strongly feel that we shouldn't mind paying taxes. They pay for hospitals, roads, bridges.
Oh yeah. Yeah,
right?
yeah, we're all good citizens. There's
We're
no
all
question.
good citizens.
Yeah.
But then, Randy, we hear, we all hear these stories of what the government is doing, the various governments, municipal, provincial, federal, and they're frittering away at these dollars that we have earned and sent to the government. And so it's no wonder we get upset when we talk about taxation.
Don't even get me started, because you're absolutely right. It's brutal, actually, in a way. Anyways, so I'm very fascinated. I want to learn about this, and I know sort of that the center point of this, or what makes this possible, is a special type of mortgage. There is a special type of mortgage, and make sure I'm saying it right. It's a re-advanceable mortgage, which does exist, and I'm going to let you explain it. One question: do these mortgages exist at the main 5 Canadian banks like TD, BMO, Royal Bank? Can you get a re-advanceable mortgage from them?
Yeah, there's re-advanceable mortgages are offered by a wide variety of mortgage lenders. And I'll explain what a re-advanceable mortgage is in just a moment. But I'd first like to preface this, that anybody considering the Smith Manoeuvre really needs to look into the appropriate financing with the help of a professional, because while there are a lot of different re-advanceable mortgages out there, they are not equal. And just going to your bank that you've been dealing with for 20 years and saying, I want to do the Smith Manoeuvre, I need a re-advanceable mortgage. The mortgage specialist is going to go, what's a Smith Manoeuvre? I don't know what that is, but we do have a re-advanceable mortgage, and it's most likely not going to be ideal for your personal situation. So in any event, what a re-advanceable mortgage is, we know that in Canada, we get a down payment together, we scrape that together, we go to the bank and we get a mortgage from the mortgage lender or whoever it is.
Right.
And it's typically one big, large amount, $300, $600 million.
These days, yeah,
and growing.
Yeah.
And all of that debt, we promise the banker, our spouse, and God that we're going to pay this off over 25 years or so. And all of the interest on that is non-deductible. And that's what makes it so expensive, even at today's low rates. It takes a big chunk of your paycheck.
Yep.
But what a re-advanceable mortgage is, and again, they're not all identical, but essentially they have a line of credit which is attached to that traditional amortizing mortgage loan.
Okay.
One or more, depending on the lender. And both sides of this mortgage talk to each other. So when you make any sort of payment against that traditional mortgage component, that, let's say, $600,000 mortgage balance, you make your first payment in a lot of that goes to interest, non-deductible interest. It's gone. It's the price we pay for borrowing the money. But let's say $2,000 reduces the principal balance on that. Well, the line of credit sees that, and the limit automatically increases by $2,000. So you can start with a zero limit on that line of credit. But as soon as you pay down that mortgage balance by $2,000, you can get back at that $2,000. Now, the issue is that a lot of Canadians have this type of mortgage already. They don't necessarily know why their mortgage specialist or mortgage broker put them into this. They don't fully understand it. They don't know how to utilize it to their maximum advantage. And so what they do, after they see that first mortgage payment reduce that balance by $2,000, the line of credit limit increase by $2,000.
Right.
Fantastic. That's more than a BMW payment, right? I can also go out for dinners. I can get a kayak, a motorcycle, travel, all this sort of stuff. And so what they're doing here with this type of mortgage is, and quite possibly unwittingly, they're paying down non-deductible debt on one side, which is expensive, and they're replacing it with non-deductible debt on the other side, which is also expensive.
Correct.
And that's not the worst of it. What they've done is, while they're increasing that line of credit balance with non-deductible debt, what have they bought with that money? They bought cars, as I said, motorcycles, vacation, all these quote unquote, all these quote unquote assets, which decline or depreciate in value.
Right.
So we call this wealth destruction. And the Smith Manoeuvre relies on the principle that the CRA says, if we borrow to invest with the reasonable expectation of generating income, we can deduct the interest on that.
That's right. And
so all we're doing when we implement the strategy is we're putting this available credit to work for us, not against us. We're going to buy investment assets, which are going to grow in value over time. And in doing so, we create these tax deductions.
Okay. So let me make sure I've got this straight. So many people have a mortgage, many people have a line of credit, or we call it a HELOC. I guess that's the same thing, where you get a home equity line of credit, but those are typically separate from each other. And what we're talking about here with this re-advanceable mortgage is the two things are joined together. both the typical mortgage loan plus the line of credit are connected.
That's right. And that's, sorry, go ahead.
I was just going to say, and when you make a mortgage payment, that increases your available credit on the line of credit simultaneously. So they're joined that way.
That's a very large misconception here.
Okay.
There are lots of internet forums, discussions, etc., on the Smith Maneuver on the internet, but it's a rat's nest out there. There's tons of misinformation. Strangers helping strangers who aren't professionals, right? And one of the biggest misconceptions is, well, let's say I've got a traditional mortgage from RBC,
right?
But I've got some equity in my house I can access. So I'm going to go to CIBC and get a HELOC in second position, or maybe I also get it from the Royal Bank, whatever the case may be.
Right.
And I can pull that out and I can invest. Yes, you're getting invested for your future. Yes, you're generating tax deductions because you borrow to invest, but no, you're not converting your mortgage because the line of credit limit does not speak to the amortizing loan side. So you pull out that full new $50,000 to invest, for example, and then the next month you make another mortgage payment, it goes down by $2,000. You can't get back at that $2,000.
I got you.
So it's a very specific, it's not just slapping a HELOC against your mortgage in second position. It's a very specific type of mortgage.
Okay. Interesting. Okay.
Yeah. So that is, step one in the Smith Maneuver, getting the right type of mortgage so that you can actually begin converting your non-deductible mortgage debt to tax deductions. So whenever I pay down that one side, I borrow it back to invest. Stocks, bonds, mutual funds, mix, REITs, private lending, investment real, all these sorts of things qualify for deductible interest.
Okay.
So I pick what is best for me. I consult with my financial advisor, whatever the case may be. So now I'm getting invested on a monthly basis. I'm generating these tax deductions as well. At the end of the year, when I send my tax return in, the CRA says, well, we came in every 2 weeks and took tax off your paycheck, but we didn't know you were going to generate all these tax deductions. We took too much. We owe you money back.
Right.
So when I get this tax refund, I apply it as a prepayment against my mortgage. And then that line of credit limit opens up again, dollar for dollar, no matter how much that was. And I can pull that out to invest as well.
Smart move.
By making this annual prepayment, I'm getting rid of that non-deductible debt faster, and faster is better when we're talking about non-deductible debt. And this is money that otherwise wouldn't exist if I weren't implementing the Smith Maneuver.
I get it. I understand what you're saying, which is remarkable for me. So, okay. And I would guess, so that's 1 year, and then over time, you're going to sort of transfer the type of loan that you have from a mortgage more to a line of credit. At each year that goes by, it's going to be more and more the line of credit and less and less the mortgage.
Exactly.
The way of transferring that. I get it. I do.
Yeah. So each year you continue this process. Each year you receive the refund, and the refunds get larger and larger each subsequent year. And your investment portfolio is growing, compound growth, taking advantage of compound growth. The main issue that a lot of people face with this is they've grown up being told by people, quote unquote, wiser than them and older than them, that they need to be clear title onto their house. They need to pay out that mortgage.
I was just thinking
clear
that.
Title, right?
Okay.
And so what happens is, and typically we have this.
Your total debt is not going to go down. It's going to stay the same.
That's right. And so this is where we face a challenge with some of these Canadians, because it's been ingrained in them to be clear title. But what they're doing is each month when they make those mortgage payments, they pay down that debt, they're increasing their equity. But what are they doing with that equity? Absolutely nothing. They're earning 0% on it. Most
of the time, nothing. You're right.
Right. And not only is it earning 0%, it's negative return because of inflation. And that's much better than actually reborrowing it to buy consumer items that depreciate in value.
Right.
But if I'm concentrating, we Canadians take this sequential approach to our financial affairs. We've got two goals. One, get rid of that mortgage. Two, start saving for our retirement.
That's right.
But the decision on which of these goals to attack first is made for us, not by us. Because if I don't take my after-tax dollars and put it away in an investment portfolio for my future, nobody cares. Nobody's going to come knocking on my door. No one's going to go tisk, tisk, tisk.
That's right.
I'm the only one who's got my back. But if we don't make a mortgage payment, someone is going to come knocking on our door.
And they have no sense of humor. Absolutely.
They have no sense of humor. So that's what happens. We realize that we've got limited dollars. And so we apply that money to making our mortgage payments. And by the time we hit retirement, we're now in a $1 million home,
right,
which is clear title.
Right.
and I'm living off a fixed income because I haven't been investing for the past 25, 30 years. I've been paying out my mortgage. So now I've set myself up for being financially reliant on my children, living in their basement suite, a reverse mortgage, working during retirement, because I haven't been able to take advantage of compound growth. And what the Smith Maneuver does is it eliminates that non-deductible debt faster than if you're paying off the mortgage traditionally. Plus, it generates this investment portfolio, which can be worth hundreds of thousands. So now you've got an investment portfolio, you can draw income from it, and you don't have these limited options. You can go golfing, you can go tend to your garden instead of working at McDonald's.
Not a bad idea. Right. Oh, yeah, exactly.
Yeah.
Okay. Number one question: CRA know about this and they're okay with it? Like
yes.
It's been around for years, I know. So they're all right.
Yeah, it's been around since the mid 80s. Back in, I'm not sure exactly when it was, but back in about the mid 90s, I think, towards the late 90s.
Okay.
My dad at his office got a surprise visit by two gentlemen in suits, and they walked in and they said to his receptionist, we'd like to speak to Mr. Smith about the Smith Maneuver. So,
oh boy. Okay.
So Dad ushered them in, and they sat down at his desk, and they explained, "We're from the CRA. We want to hear what the Smith Maneuver is all about."
Right.
And Dad, being Dad, he probably lit up, and he got his pad of paper out, and a pen, and
he's a brave man. He's a brave man. Okay.
Well, he did his research. He knew that we were simply taking advantage of our best financial circumstances, which we are legally entitled to do. So he explained what it was, and halfway through, one of the guys leaned forward and said, "Is this going to work on a $70,000 mortgage?"
Are you serious?
Yeah. So, and plus, there are.
That's good.
I know for a fact there are people who are employed by the CRA who are implementing the strategy. Yep. I've had lawyers, accountants as clients, you name it, cops. So
interesting, very interesting. It's kind of intricate, but it's also kind of simple in a way. Basically, you're just tying those two different things together, and you are automatically generating a line of credit, but you have to pick the right investments. Okay, so I'm going to play devil's advocate a little bit here. I mean, when you are using borrowed money, which is basically what it is, to make an investment, it's like buying stocks on margin, which there are some risks involved with that. I would think, and I'm just kind of shooting this out there, that this is going to work for a certain type of person who is perhaps hands-on, who is on top of things. But I don't know the average Canadian who, makes a contribution to their RSP once a year and then forgets about it for the next 12 months until they get their final, the year-end statement. They don't even look at it. Would it not might make better sense for someone who's a little more hands-on, because you got to make sure that those investments are going to go up in value, not down, because that's borrowed money that you're using to buy with.
Yeah, the Smith Maneuver is not for everybody.
Right.
Firstly, you have to have at least 20% equity. Okay, it's a little off topic here.
No, that makes sense.
In order to get the right type of mortgage.
Right.
But secondly, the people who are going to shy away from this are those who can't wrap their head around the fact that the Smith Maneuver says you're going to want to maintain your total debt. You're going to convert it from bad to good debt and get invested, but you're going to want to maintain
number one objection.
Yeah, and a lot of people are going to say, I can't wrap my head around that. My wife, my husband, if I tried to persuade them, they'd kill me, whatever the case may be. And so that's fine. You don't want to do anything you're not comfortable with, right?
Right.
But if you do implement the Smith Maneuver, you are required to invest. Now, we need to be very careful on what we invest in. And I tell everybody, I don't advise on what to invest in. It's up to, what are they comfortable with? What do they have an understanding of, right? But I advise them, don't take this money. Like if it's freeing up $1,100 that you can invest, don't take that to Vegas, quote unquote. Don't gamble on your cousin's new
Bitcoin or penny stocks, stuff like that. No.
There's a lot of stuff out there that have generated consistent returns for years and years and years. They may be boring.
Right.
They may not be exciting, but this is
boring. Can be good.
Boring. This is a long-term strategy. So the fact that it's a very, very long-term strategy really flattens the market risk curve on this.
Okay.
You do have to get it right. And there are a lot of people out there who've got their Questrade account or their Robo or whatever, and they're doing their own investing. That's going to be fine for some. A lot of people, they're full-time school teachers or policemen or they're not money managers. And so it's time to enlist someone who can help guide you on this, who you trust.
Absolutely.
Who can help guide you. And there are people out there who've got a lot of letters behind their names. They do this for a living.
Yeah.
And, sure, we need to be cognizant of fees, but we're talking about your family's financial security here, long-term security. And we shouldn't, unless we're professional money managers ourselves, we shouldn't try to attempt to do this. We shouldn't try to do our own taxes, our own investing. We shouldn't try to pick our own mortgage. Enlist the professionals.
I totally agree.
Yeah.
Totally. Well, okay. Very interesting. What happens? Okay. So you got it set up. You're doing the Smith Maneuver. Everything's working great. You have to sell the house. You're being transferred. You're moving to Montreal. You got to sell your house and move to Montreal. How does that work in terms of your investments? Or do you take that? Is it transferable or is it portable? Can you move it with you, or how does that work?
Yeah. People move all the time.
Yeah.
And there is a way. If you're implementing the Smith Maneuver, what you're concerned about is the deductible debt that you've generated to date.
Right.
The investments themselves are free and clear. They don't care where you live, because I took from that line of credit to buy investments. The lender, the re-advanceable mortgage holder, doesn't care what I do with that money. They don't care if I borrow from that line of credit to buy a car, to invest, to go on vacation.
They should. But okay.
Well, maybe so.
Yeah.
But they also don't care if I take that money out, turn it into cash, and throw it in the fireplace and burn it, because they've got the house as security. That's what security for the credit.
Okay,
so the investments are free and clear. They're not encumbered by any debt.
I gotcha. So when the house is sold, the existing mortgage is paid off. Likewise, the line of credit is paid off. So everything's cool.
Well, the way that we want to engineer this, and it's done all the time, but you need to have someone on your side who understands this. So maybe we'll talk about the Smith Manoeuvre Certified Professional Accreditation Program in a second, but
oh boy, okay.
there are these people out there, mortgage brokers, notaries, etc., real estate lawyers, who understand how to structure the sale of your current home and the purchase of your new home such that the deductible debt that you've generated to date can be ported over to the new house, rather than paid out and eliminated and having to start again on the new house.
Good. Okay, good.
Yeah. So it can be done.
Okay.
I mean, moving house is a frequent occurrence, and
it is.
Tons of clients that have moved house. Yeah.
Yep. My favorite clients, when they move at least every 5 to 6 years. I think the Canadian average is 7, but we like people to move. It's always a good thing.
Yeah. It keeps the economy going.
That's right. Very interesting. Okay. What about demographics? Again, I'm a little bit older. Some people would say I'm a lot older, but with this, I would think this is appealing more to people with in a younger demographic, if they've got in their like late 30s or 40s, where they've got 20 years to look forward to building assets, whereas somebody who might be 58 years old, maybe that's not the right thing for them. I'm not sure.
Well, there are Canadians in their 60s and above who have begun the process of the thing to remember here is, firstly, we're living longer. So if I'm 60 years old,
that's not old these days.
It's not old these days. And if I've got debt, I really need to have a serious discussion about whether I can convert that into an investment portfolio. If I'm 60, am I going to live to 85? I've got some time.
Maybe. Yeah, maybe
85 or older. So it's about figuring out, what do the numbers say and what are the timelines, and does that work for my personal situation? So yes, there are people on the more mature end of the spectrum who are implementing the strategy, and there's a lot of interest in the strategy for people in their mid 30s, 40s who are looking at their first home. Granted, the number of those aged people are dwindling, considering expenses, the cost of buying a house these days, but they have a lot of time to watch their investment portfolio grow. They've got a lot of earning power in the future. The 45s to 50-year-olds really are the ones who are really embracing this, saying, I've still got lots of time.
So I've
still got lots of debt.
That's your ideal demographic right there. 45.
Yeah, they're going to likely have owned their home for a period of time whereby they've got the available equity that they can get the right type of mortgage. If I've only got 5% down when I buy my first house, I can't implement it because a mortgage lender for a re-advanceable will only extend up to 80% loan to value. So someone who's
Understood.
45, maybe they've owned their home for a while, the equity's built up and they can get the right type of mortgage. And the older one is, we can talk about accelerators, but the older one is, if they refinance out of a mortgage that doesn't work for the Smith Maneuver into one that does, they may have immediately available credit based on the value of the house of 25 grand, 50,000, 100,000. These days, 200,000.
Easy. Yep.
400,000. Right.
Yep.
Now, when we talk about pulling that equity out to invest, it's one of the accelerators. It's called Prime the Pump. We're talking about accruing new debt. If I've got a $500,000 mortgage on my existing house and the mortgage doesn't work and I need to refi into a mortgage that does work, I still owe $500,000. My debt hasn't changed. Now I have the opportunity to convert that mortgage debt into an investment portfolio. But because the value of my house has gone up over time, I also have a couple $100,000 that the lender is saying, hey, not only do you owe us that $500,000 non-deductible mortgage debt like you did with the old mortgage lender, but we're also going to give you a line of credit with an immediately available limit of 200 grand. Do with that what you want.
Right.
And that is additional borrowing. That's additional leverage. And this is where you really need to have that conversation with a professional. Is it suitable for me to pull that out and invest? What's my age? What's the my capacity to carry this additional borrowing? What are my goals, my timeline, all that sort of thing.
Understand.
So there's a lot to consider. And you mentioned earlier, it's simple and complex at the same time. And it is, because I can describe the Smith Maneuver as pay your mortgage down, borrow it back to invest, take the tax refund, prepay, pull that out to invest as well, and you're on your way.
Yeah.
But the actual, we're dealing with mortgage financing, we're dealing with investment math, and we're dealing most importantly with the CRA. So there are nuances in here where you need these professionals to help you implement it correctly.
Right. Okay. Devil's advocate. I like this. Very interesting. The one thing that I think would screw it all up is there's an assumption built in that house prices will continue to rise. And we've been in a really good time the last 20 years, man. I'm sure out in Victoria and BC, I know for a fact, even more so than here in Ontario, prices have been on a tear. And but there's an assumption built in that prices will continue to rise. And I hope they will, but you never know. Anything's possible in the world, right? What would happen if prices started to soften? Is there a danger if you're keeping that debt level high like that? Is there a danger that eventually you could end up underwater? Or is that if interest rates start to go up and we might see a dip in prices? I don't think we will, but we might. You never know. Is there a risk there?
Yeah. So there's two things there. There's softening of prices and interest rates, which you mentioned.
Okay. Yeah.
My father developed.
Rates are going up, by the way. You heard it here first.
I'm pretty sure they're not going down anytime soon.
Exactly. Where can they go? Yep.
So, talk about the softening of real estate prices first. My father developed this back in the mid 80s.
Okay.
And the housing prices have gone up and they have gone down. They've gone up and they've gone down.
1989, a bad year. Yeah.
Yeah. So when we're implementing the strategy, we're implementing it on a principal residence. The day I get my financing for this, I'm up and running. I can get to this. Now, firstly, it's not like the stock market. If prices start going down, I can sell. First of all, I don't want to sell. This is the house in which I live.
Right.
And I've got a 5-year term on this. And regardless of what housing prices are doing, the mortgage lender is going to say, hey, renew for another 5 years, sign here. It's a different story if I buy my house with 5% down. Then I'm really looking at this going, what's going on with housing prices? I'm a little concerned here, whatever. But in order to do the Smith Maneuver, you need a re-advanceable, and you can't get a re-advanceable unless you
20%.
have 20% equity.
Right.
So there's a big buffer there. When you talk about interest rates, again, I'll mention the fact that my dad developed this back in the mid 80s. And you might remember what rates were doing then. Back in
craziness. Yes.
So if my father developed this strategy back in the mid 80s when rates were double digits, if it didn't work then, we wouldn't be talking today. And we have to look at the fact that the Smith Maneuver is very robust because, and I've heard people on internet blogs or whatever it is say, hey, the Smith Maneuver is not going to work when rates are high. I've also seen Smith Manoeuvre is not going to work when rates are low. Well, here's the thing.
I get all my news from Facebook. I don't know about you, man. But
that's right.
Yeah.
Here's the thing with rates is when interest rates are low, as they are now,
right?
Just because of how the math works, I have, let's say, $1,100 to invest on a monthly basis.
Okay.
Now, interest rates are low. I'm investing a relatively large amount on a monthly basis, which is fantastic. However, my tax refund isn't as large as if rates were higher.
Correct.
So yes, I'm getting invested a bunch right now on a monthly basis, but my tax refunds and my tax deductions aren't as powerful. Well, when rates go up, I have less. So maybe I don't have 1,100 to invest each month. Maybe I've got 900 to invest each month. So I can't invest as much, but my tax refunds are higher or bigger because rates are higher. So there's this balancing component to it.
Very interesting. I keep trying to trip you up and nothing's working. And what I can see, everything makes sense here. It makes perfect sense. Yeah. Everybody should be doing this.
Just in case you don't ask, I mean, I'm sure your viewers or listeners are going to be wondering, what are the risks? We talked about a couple of them. There's interest rate risk.
Yep.
There's, interest rate risk. If I've got a mortgage, I've taken on interest rate risk to begin with, whether or not I'm doing the Smith Manoeuvre. If I'm doing the Smith Manoeuvre, I've also got that line of credit component, which has its own rate, quite likely.
Right.
And so I'm also opening myself up to additional interest rate risk. But again, the long-term nature of this smooths out that rate risk on the interest side. And as I mentioned, my dad developed this back in the mid-'80s when rates were double digits. So there is risk on that side, but it's, as long as things keep on going relatively normal and we don't see rates in the 30s and 40s and stuff like that.
I hope not.
It's proven manageable.
Yeah.
Market risk, again, you're exposing yourself to you're getting invested with money that otherwise you weren't going to invest, because otherwise, without doing the strategy, the money's not available to you. So now you're getting invested. There's market risk there.
You could have a GIC and the rates are going to go up on your investment. So if rates go up, you may get a higher rate of return on something simple like a GIC, which I wouldn't recommend. But we always
want to look at when I'm borrowing to invest, I'm paying for that borrowing.
That's right. It's got to be.
Does it make it worthwhile?
GIC is a bad example. Anyways.
Okay. But we also have to remember that if I'm borrowing, we're borrowing at 2.95% these days. But even if I'm borrowing at 6%, if I'm at the 50% marginal tax rate,
right,
it only costs me 3% money.
Right. That's right. You're going to get half back.
Yeah.
Exactly.
So interest rate risk, market risk, regulatory risk, the government, the CRA, they can make any change they want at any time. When I was an advisor, we saw quite a few moves, how do we deal with this? Okay, well, it diminishes the effectiveness of the strategy over here, but it's okay over here, balances, that sort of thing.
Okay.
There are all sorts of risks that one faces when they are implementing a financial strategy, regardless of what that financial strategy is, right?
Life is a series of risks. Sometimes it's a big risk, sometimes it's a small risk. Still a risk, but oftentimes if you go with the small risk, you're going to be okay.
People take a risk every day when they get in the car and make that drive to work.
Better believe it. Very interesting. Let's say someone listening to this today or someone watching us today is interested. They're in Canada. They've got, they got at least 20% equity in their house, and they're interested maybe in taking a look at the Smith Manoeuvre. What should they do next?
Smithman.net.
Smithman.
SMITHMAN.net.
Okay,
it's shortened from smithmanoeuvre.net because no one can spell maneuver correctly, including myself.
I can't. I had to look it up. Anyways, I'm going to put your contact info underneath on the YouTube and also on the podcast as well, so people will be able to contact.
So smithman.net. I've got my book there. I for those listening on the podcast, you can't see this, but it goes on YouTube. There it is, Master Your Mortgage for Financial Freedom.
Awesome.
So there's the book. The Smithman calculator, which we've developed, which is very powerful. Within just a few minutes, you can see the projected net benefit for your own personal situation. I've also got a homeowner's course. But the most important thing here is you go to the website. There's more information there. You can get the book if you want, but just get the book. Go to the library and check it out for free if you don't want to pony up to $24.95, right? Learn about it, get to know it, and do the initial research and figure out if it is worth it for you or not.
Sure.
And then going forward, if you decide to proceed, then we've got, as I alluded to earlier, we've got a network of Smith Manoeuvre certified professionals, coast to coast.
Okay, good.
So mortgage brokers, realtors, investment advisors, accountants, etc. So all these financial professionals you can surround yourselves with who know each other.
Okay,
right?
and you have reps in Ontario as well.
Oh yes.
Okay, good.
Yeah. So there's a link that they can get connected to Smith Manoeuvre certified professionals. We'll connect them in their area. But that's the most important thing, is just learning more about it, educating yourself, getting comfortable with maintaining your total debt, understanding why it's
that's the big one. I know with my clients, that's going to be the number one question. Well, wait a minute. You're saying that we owe 600,000 on the house, and you're saying that we should keep it at 600,000 over the next 15 years. It'll still be 600,000 that we owe. And the answer to that is yes.
Yeah. And when you look at, well, what am I getting with that $600,000 of debt that I'm maintaining? Well, depending on your numbers, you could be upwards of $2.5 million with an investment portfolio. 2.5 minus 600 grand. I'll let you do the math, Randy, but I'd rather have that.
I'll get out my calculator.
Than a zero investment portfolio and a whole bunch of equity, which has been doing absolutely nothing for me for all these years. You tell a wealthy person that you live in a clear title home, they're going to look at you like you got three eyes. It makes them sick. They want to run away. They know the power of debt, but they know the power of good debt, not bad debt. They know the evils of bad debt.
I am not beginning to believe. I fully believe that we need to model what people think, oh, this is only for billionaires or, really rich people or celebrities or something. We need to start modeling some of the stuff that they're doing, because if it works for them, it can work for an average and ordinary Canadian as well. And I think it's great.
That's exactly it. My dad, as I mentioned, in the mid 80s, he didn't develop this strategy for the millionaires and billionaires. They already have their fancy tax accountants and tax lawyers and advisors telling them how to not have any non-deductible debt, how to maximize their tax deductible debt. They've already got the means to do that. He developed this for your typical Canadian, 80 grand a year, 150 grand a year. Big stinking mortgage, which is taking a big cut of their paycheck each month. They can't get ahead. I don't know how many families have said, I make 130 grand a year and I can't pay for my kids' braces.
That's right.
This is for them. This is so that the typical Canadian can emulate the wealthy.
I like it. I'm going to promote this. This is good. And so I'm out of questions. I mean, you've answered them all. And again, it's kind of a very elegant kind of, at the same time, simple concept. And I'm surprised that not too many people are doing it, although obviously more and more all the time. But I think a lot of people are going to get value out of this. I really do. I think it's a great idea. And
you just got to learn about it, educate, decide if it's for you. It's not going to be for everyone. As we talked about
earlier. I agree. If there's and
if it's not for you, don't do it.
Absolutely.
But look into it. If we don't educate ourselves, we don't know what options are out there. We don't give ourselves the chance to say yes or to say no.
Right. That's right. Okay. And I know you said don't bother to buy the book, get it at the library, but I'm going to say to people, buy the book. If you don't want to buy the hard copy, get the Kindle version. And so you've got it at home. You can read it on your phone. You can read it on your desktop, whatever. I would urge people to do that.
I'd love it if they bought the book. I'd love it more if they just
come on, Rob. Come on.
All right, buy the book.
You're a businessman. Come on. Anyways, this was a great talk. I really enjoyed this today. And let's keep in touch. And like I say, I'm going to put all your contact info there. So hopefully we can drum up some business for you. For anyone still on the call, anyone watching or listening, if you have questions, please put them down there. Please put your questions and we'll try to answer them in a timely manner. And if you're on the YouTube channel, don't forget to subscribe. If you like what you're seeing, give us a thumbs up. Likewise on the podcast. And the podcast, by the way, is on Podbean, but it's syndicated everywhere. It's out on Apple, iTunes, and Spotify, and Stitcher, and a whole bunch of other ones. So we'll be all over the place in very shortly. So Rob, thank you again, sir, for being here today.
It's been a pleasure, Randy.
It was a pleasure talking to you. Okay, hopefully we'll see each other again soon.
You got it.